Hello and welcome to the special State of the Economy show. We are covering the December CPI numbers and the November industrial output numbers. The December CPI number has surprised on the downside. As you can see on the ticker, it's 5.69%. The CNBC TV18 poll was expecting 5.9%. So this is much lower than the street was expecting, at least 20 basis points lower. And that would be extremely gratifying for the Reserve Bank. Even if it was 5.9, the average for October, November, December would have been 5.4%, lower than the RBI forecast of 5.6. So the inflation trajectory would be anyway running below the RBI's forecast. Now with 5.7 or 5.69% reading in December, the trajectory is comfortably below the Reserve Bank's forecast, and therefore there could be a minor expectation that the Reserve Bank may change its stance as early as February, but I'm getting ahead of myself. Let me give you the other important numbers that we are watching for. The CPI food price inflation is coming in at 9.5%. That's more or less as per our poll as well. We were expecting a 9% according to about 4 or 5 respondents in our poll. Cereals and products index is up 0.8% on the month. That's a bit of a bother. Cereals going up by 0.8% on the month. Year on year, of course, it's much higher. The food and beverages index for the for the month is down by 0.7%. That's very important that it is down. It was expected to be down, but economists were expecting about half a percentage point lower, 0.5%. The fact that it has come 0.7% lower is accounting for this headline inflation coming so much lower, because food prices have fallen more than perhaps what analysts were expecting, and that's led to the lower than expected overall inflation as well. Just a few other readings: fuel and light up 0.2% on the month, clothing and footwear up 0.2% on the month, housing index down 0.6%. So the overall miscellaneous index, which is broadly services, is down 0.2% on the month. My sense is, therefore, we should get a core inflation number of 3.9%, which is what our poll said. I think it will come in line with expectations at 3.9, but let's wait and see. The other number which I was hesitating to read, which has not come down very well, is the November industrial growth number. That's come in at just 2.4%. Our poll said 3.5. We must remember that October, because this is a November number, the October number was 11.7%. It was always expected to slow down a bit because the bulk of the festive production would have happened in October. The festivals have come in November. November would have fewer months of output because of the holidays, the Diwali holidays. But nevertheless, the fact that it is only 2.4% could be a matter of some worry that that number, whether the overall industrial output number, which the NSO has forecast at 7.9 for the full year, whether that will be realized could be a bit of a bother, but we will wait and see. For the moment, the numbers are looking very good on the inflation front. So let me start with our guests. On that note, I have with me in the studio Sameer Narang, the chief economist from ICICI Bank. Also joining me are Rupa Reginitsude, the chief economist at L&T Finance, Aditi Nayar, chief economist at ICRA Limited, and in a bit we will also be joined by Sandeep Yadav, the head of fixed income at DSP Mutual Fund. Gentlemen and ladies, okay, it's an equal house. Thank you very much for participating in our show. Rupa, let me start with you. 5.69, good news?
Yeah, but it's close to my forecast. I was expecting it to be 5.63 because sequentially you had seen in December many prices, including that for cereals, fruits, vegetables, pulses, have come down. Of course, thanks to government's efforts and supply side measures. Okay. So, lot of spikes were well controlled. And, I had expected beverages inflation to come down by 0.7%. So my forecast was very close to that. But as I told you in my earlier interviews, MPC has very clearly warned the whole ongoing disinflation process vulnerable to food price shocks. And that's why they will like to be vigilant, because now their target is 4%, and in a very systematic and dedicated fashion, now they are following inflation targeting framework. So I think they will avoid premature easing, and they will remain data dependent.
Easing, okay. Okay. Well, Sameer is with me in the studio. Sameer, what do you make of this number? 5.7 compared to a forecast of or expectation of 5.9. Should we start expecting that there could be a change in stance?
So I think, number of course is lower than what we thought. I think most of it would also be driven by the fact that veggie prices would have surprised on the downside.
Yes.
We were anticipating a decline, but I think the decline is much bigger. But as you were saying the numbers, you also pointed that housing is down another month, and then we have miscellaneous probably declining. So core perhaps would be even lower than 3.9. Our estimate was 3.9, but we were anticipating some increase on a month-on-month basis, at least in miscellaneous. So overall, I think very good set of numbers. If you read through the minutes last time around, some of the RBI members were pushing back on probably change of stance. The external members were much more in favor of probably doing it. I think the first port of call would be easier liquidity conditions and then a change in stance, but we'll still probably look at an April is when it should happen.
Fair point. I don't think unless, that liquidity they're comfortable on, and there is an asset price inflation which the Reserve Bank may worry about, but that debate for another day. Let me come to you, Aditi. What's your sense now? Has this number surprised you on the downside, and will you want to revise your full year forecast as well? It's clearly come undershot our poll.
Thanks, Lata. We were expecting 5.9% today, so it is comfortably below our expectation, with both food and miscellaneous coming in below what we had forecast. This is and was expected to be the peak CPI trajectory. We're now looking at a number that is closer to 5.2% for the current month. So I would say that we probably, instead of 5.4, now be at 5.3. But not a huge difference in our average CPI inflation forecast for FY24.
Okay. I think now the most important person would be Sandeep Yadav, the head of fixed income at DSP Mutual Fund. Sandeep, how will the bond markets react? Do you think you will start factoring in a likely change in stance as early as February? The number is clearly undershot.
You're absolutely right, Lata. The numbers have surprised us also, as well as the street. But I believe expecting a change in stance or expecting RBI to be hawkish in February might be a little bit too early. We were quite surprised the way RBI has been hawkish for the last two policies. And so suddenly, is this number a game changer where RBI will suddenly pivot because CPI is 20 basis points lower than expected? I don't think so, because a couple of reasons that RBI did mention is firstly that they said headline inflation target is 4%. If they really stick to it, then it's not a game changer.
Okay.
But what I really do find interesting is that the core inflation, as Sameer mentioned, could probably be lower than 3.9%. And one of the minutes of the meeting, one of the important reasons why RBI was the way it was because they mentioned that output gap is probably narrowed. If your core inflation is actually coming lower, and what Ms. Ashima Goel had mentioned in the minutes, she said that probably the output gap has not narrowed and it's still large. And if that be the case, a core CPI in a way validates those points. And then I would presume that yes, at least the doves in the MPC have more food for thought over here. And they should, I would personally think that if not in February, then sometime soon, we will see RBI pivoting. It's difficult to time it though.
Okay. Yeah, I mean, see, what gives me perhaps a bit of a doubt whether the Reserve Bank would pivot as early as February is simply that the number is definitely going to undershoot their full year forecast. Their Q3 forecast was 5.6%, and now the math is giving me 5.36, 5.4. 5.36 is just a little better than 5.4. So given that it is, undershooting to this extent, would you want to redraw the full year trajectory?
Lata,
not too early.
No. So if you see the Q4 numbers, we are at close to 5.2. It's centered around 5.25 plus minus 10 basis points each of those months. So it actually does not change the full year trajectory, because we were at 5.44 or thereabouts. So it actually brings it probably a little bit less than 5.4, but again, rounding it off, it'll bring it to 5.4 again.
Okay. So clearly it's not overshooting, and if anything, there is a good chance. I mean, considering that both November and December, the CPI number has seriously undershot the market expectations. Usually the trend continues, or at least is expected to. So chances of perhaps undershooting the Reserve Bank's trajectory cannot be taken lightly. And as well, you've got the core coming in at 3.9. So that would point to the Reserve Bank has in prior policies addressed the core separately. So for both reasons, if that's below 4 and the trajectory is likely to be undershooting their own 5.4%, then there is some hope that even if the rate cut is far away, change in stance could come earlier. But before we get back to the inflation debate, just a word on the industrial output number. That's not looking good at all, at 2.4%, and the culprit would be, I think, well, actually all of them. Electricity is growing at 1.2%. No, it can't be. Electricity is growing at 12.7%. Manufacturing at 6.5. I think I'm getting it mixed up. Mining is at 6.8. Manufacturing is 1.2. I think that's the one that's clearly disappointed. At 1.2, that's bringing the average down. And within industry, if you remember, October industrial output was 11.7. It's been moderated to 11.6. That's the revised number. Not much. Consumer non-durables has not done well at all. Consumer non-durables growth is minus 3.6%. Consumer durables is minus 5.4%. Then intermediate goods 3.5%. Capital goods is again minus 1.1%. So this is a very disturbing number. It's electricity which is holding up at 5.8 and mining at 6.8. Rest of the numbers are a bit troubling. Would you start worrying right away, Rupa?
Not actually, because you see, November had Diwali and lot of, for many days the factory activity was
holidays.
shut. So yeah, so that was one of the reasons. Secondly, we had seen in the core industrial output also, cement had posted negative growth because, dust-induced pollution levels were so high that many state governments had imposed restrictions on construction activity. So that also had impacted, And rural consumption, Lata, has been passing through a rough patch because of extremely patchy monsoons and very low reservoir levels. So what we are seeing actually in our research is that the consumption recovery has been uneven, especially in rural belts. The northern and eastern regions which have received very good rainfall, there we are seeing good momentum of consumption demand. But western and southern regions which have suffered from very low rainfall, there the demand for mass consumption goods in rural belts is very weak. So that is getting reflected in consumer goods growth numbers. But having said that, based on just one observation, we cannot say that we can make out about the trend. Maybe this number will get normalized. It will not be as high as double-digit growth. But certainly, it will be much better than what we have seen in the month of November. Because December, the overall high-frequency indicators were good. Yeah.
I agree with you. We are getting contradictory or mixed data at this point in time. But the NSO typically looks at the first 8 months that it has and extrapolates for the full year. And there they have extrapolated industrial growth at 7.9%, which is fairly strong. And we will have to see whether this is a one-off in November or whether the NSO extrapolating the very strong first 9 months is perhaps an analytical mistake. Where would your heart lie, Samir? Should we worry that,
see, if you see the
10th month is not as good as the first time?
No, so I think that's the way we looked at it was that in H2, the GVA growth was pegged at 6.2, and we were very similar to that. For the year, our GVA projection was 6.8, NSO was 6.9. I think the deviation is between the GVA and GDP because of how subsidies and taxes are likely to play out. So I agree with you, there could be some bridging of gap that we have seen right now between GVA and GDP, and they may normalize together.
Yeah, I agree. We are looking at very fragile, or very meager evidence, but it does put a doubt. After all, we know that the NSO is extrapolating from the first few months' data, first 8 months' data, and if the remaining months don't come out as the first first 2 quarters did, maybe that 7.3% is in danger. Aditi, what are your thoughts? Do you think that 7.3% was always in danger and now it gets endangered a bit more?
Yes. Let me start with the IIP number. Our forecast for this month was 2.2%. So what has come out today is really not very different from where we were projecting the number. Last month when we were looking at the numbers, I remember having this discussion with you about how October is an aberration and November is the reverse aberration. This happens every time that the Diwali month shifts. Now, I would say the good news within this is that the average for these is not bad at all. Having said that, I am projecting IIP growth in low to mid single digits in December. And electricity particularly did not do very well in the early part of December because I think the winter was quite late, not necessarily a more broad-based reflection on industrial activity. But the high frequencies are quite mixed. I think half of them have improved over November and half of them haven't, roughly. So I'm looking at a low to mid single digit IIP for December. Overall, I would still say that H2 will show significantly slower growth compared to H1. My GDP growth forecast for FY24 is around 6.5%. GDP GVA roughly both around 6.5%. And other than rural, which Rupa has already talked about, one other concern we have is if we look at Government of India's own capex numbers for October and November, October was such a deep contraction that the low growth in November hasn't actually pulled the total capex for these 2 months into the positive zone. So I think that is something we need to watch out for.
You need to watch out for government capex, you're saying? Yeah, okay. I don't know if I got Aditi's reply to that, but it does look like people are not taking the 2.4% very seriously at the moment, sticking with stronger growth expectations. Sandeep, to what extent will the markets react at all to this? Or is this inflation number, lower than expected inflation number, relevant for just, half an hour or 1 hour till the US PPI number comes? And then all eyes will be on the personal consumption expenditure of the US. Do you think that will be more relevant than this for the bond markets?
Yeah, absolutely right, Lata. I think while there are many things, drivers in the market right now, but US yields and US data is turning out to be bigger than a lot of domestic data right now. A 20 basis point move in CPI is not something which will lead to a significant move in bond market. Yes, we'll see a noise. Yes, we'll see people who've been staying out of the market. Probably they might enter right now because the margin of safety for people who are not invested has reduced significantly after the CPI number. Nonetheless, currently the bond market is tracking what is happening globally much more closely. They're tracking Brent, they're tracking US yields much more closely. I think a large part is because we have seen in the last couple of years that RBI has literally, I would not say specifically, but in quite a few times they have been going along with Fed, and from at least that's a market perception. And suddenly a 5.9 number coming at 5.7 is nothing which is a game changer. But yes, if PPI number changes US yields significantly, then that is probably going to be a bigger driver. Okay.
Well, for your information, I'm just getting the NSDL's FPI net debt investment, 108 million today. This must be something of a record. I mean, we see this once in a way in the stock markets. The stock markets is a net bought figure. It's $7.9 million. But debt is $109 million, 108.9. So we're almost there. That's a huge appetite that foreign investors are showing for Indian debt, probably triggered by the fact that now the Bloomberg index also, there is another, sweetener coming over there in terms of the inclusion. Okay, so now a quick rapid fire round for all of you for your forecast. I know you'll have already given it to me, but just very quickly, to refresh. Samir, let me start with you. Your GDP and your CPI forecast for the full year.
Well, we projected a GVA and GDP of 6.8. I think given the way the numbers came out, GVA was pretty much in line. GDP could be...
You will stick with this?
I think GDP could be around about 7%.
Okay.
And GVA will be 6.8, 6.9.
Okay. So you may upgrade your number from 6.8 to 7.
Yes.
And your CPI stands at for the full year?
5.4.
5.4. Okay, that's where the Reserve Bank is. Rupa, yours?
My full year GDP forecast is around 6.6%. GVA not much different from that.
Okay.
And full year inflation forecast is 5.6%.
Oh, 5.6. So you're not very sure the trajectory holds. Aditi, yours?
GDP at 6.5% and CPI at 5.3%.
5.3. Okay. Clearly on growth, there is still not that much confidence that the NSO's number will come true. But I think the more important point is whether the bond markets have more room to go down. Sandeep Yadav, the debt number today, 108.9. And of course, we will watch out for the PPI and eventually the consumer price index number. But what's your sense? Do you see the yields going down already, or the market will watch out, wait for the vote on account and the deficit number?
We are very clear. We expect yields to move down further. I think we have just seen a cusp of FPI inflows right now, and it's heartening to see 108 million. But I am pretty much sure we are going to see these kind of days in coming months as well. And so we believe that we're in the cusp of a rally right now. Will it happen immediately? We are not sure. We've got new STM regulations coming this quarter. We don't know how the banks would react. So the next move is certainly a rally, and I don't think we have seen the rally at all right now. When it will happen will be a difficult time to predict, but we prefer being investing, and it could as well be next week. It could as well be after a couple of months. But yes, we haven't.
So you see yields going towards 7.1 or even lower towards 7.
You're talking about next week or in the longer term?
No, I'm talking in the run up to the budget. You think it goes towards 7.1 right away?
Yes, we expect 7.1 to come to there. To be honest, we'll be looking to Pune position lower than 7.1 because going into the budget, and then you've got FOMC where people have already pricing 75% probability of a rate cut in March, and then you've got India's MPC. Probably the risk to reward is not there to be invested, but yes, we do see 7.1 touching.
Okay. Okay. Oh, very quickly, what are you going with in terms of deficit expectations in the vote on account itself? I mean, market borrowing, if you have a number already?
So our sense is that you should see a 50-60 basis points consolidation. So 5.3, 5.4 is what we are going with.
So the borrowing number would be some 11.4 thereabouts.
Borrowing number would be, aggregate gross borrowing number would be 15.2. Okay. 3.7 will be repayments and 11.5
would be the net borrowing. What are you going with, Rupa, in terms of fiscal deficit?
For the current year, I think they may, slightly breach the 5.9% because of, higher likely increase in revenue spending above that.
And lower nominal GDP.
And a lower nominal GDP. So according to me, it's not any serious breach, but, because our tax buoyancy and all that augurs well. For next year, I will still wait for some more data to come. So but definitely they will.
No, I can imagine if we...
they will deviate from their earlier roadmap.
But the PMGKY announcements could come. There is a widespread expectation it would go to 8,000 from the current 6,000. In that case, perhaps we will have to rework the number.
And the subsidies they are spending, actually it is helping stabilize rural cash flows. So I think that is the need of the hour. So even if this happens, I think this augurs well for the economic growth.
See, income transfers where consumption is warranted, like in the lower echelons of rural areas, is always warranted, but that doesn't give you a right to go to 9% fiscal deficit year after year. It has to be trimmed. And you will know whether 5.9 has been breached only by May this year, when the elections will be over, because, the April end numbers, the March end numbers don't reach up until 2 months after the month is over. So it will be May end when we will know perhaps that, it was not 5.9, it was 6%, and by then it will not have much of an impact on the markets. But that's the story. Thank you very much. Aditi, I didn't ask you your fiscal deficit guess, if you have one.
5.3% for FY25 and gross borrowing at 50.
Okay, so pretty much like what Samir is telling us. Sandeep, you have a guess in terms of fiscal deficit and market borrowing?
Absolutely. We expect 5.3% as a fiscal deficit, around 50 lakh crores as gross borrowing. So quite similar to most of the participants.
Okay. All right. Well, it does look like the index, front running, if you please, or, advance buying by FPIs will have an important impact. At least today's number is almost eye-popping. So there are simply too many influences for the bond market to take this inflation number very, very seriously. But nevertheless, that's also pointing in the same direction. The Indian inflation number for December is going to be bond bullish. And likewise, the kind of bond buying that we are seeing from foreigners, the likely expectations on the vote on account, all of them are indicating that the bond market is going to take this extremely positively. Thank you very much, Samir, Rupa, Aditi and Sandeep for joining in this discussion and giving us the benefit of your comments. The news on the state of the economy is that inflation running below the central bank's trajectory. The industrial output is a bit of a disappointment, casts some doubts on the GDP forecast of 7.3, but not a whole lot. The November IIP was always expected to be a tad weak given the holidays in that month. So on that positive note, we wind up on this edition of the State of the Economy. Don't go anywhere. Lots of news and headlines are lined up for you.